Ever wonder how legendary investors like Warren Buffett seem to know exactly what stocks to buy? Do you feel overwhelmed by all the numbers and data? Today, we're going to reveal the secret. This video will show you the best financial indicators you need to choose winning stocks with confidence. So, let's talk about the problem. Buying stocks based on a news headline, a hot tip from a friend, or just a gut feeling. That's not investing. It's a form of gambling, and it's a quick way to lose your hard-earned money. But what if I told you there's a much smarter way? Imagine buying a car. You wouldn't just buy the first one you see without checking the engine, the mileage, or its maintenance history. Right? Of course not. You'd want to know if it's reliable and built to last. Well, buying a stock is exactly the same. You need to look under the hood, and the way we do that is by using data-driven financial indicators. These are the tools that professional investors use to separate the financial powerhouses from the ticking time bombs. My promise to you today is simple. By the end of this video, you will not only understand these indicators, but you'll know how to use them together to make confident, intelligent investment decisions. We're going to demystify the jargon and give you a clear, actionable framework. All right, let us dive into our first and arguably one of the most famous financial metrics, the P/E ratio, which stands for price-to-earnings ratio. In simple terms, the P/E ratio tells you how expensive a stock is relative to its earnings. Think of it like this. If you're buying a small coffee shop and it makes $100,000 in profit each year, would you pay $500,000 for it, or would you pay $5 million? The P/E ratio helps you answer that exact question for stocks. The calculation is straightforward. You take the current stock price and divide it by the company's earnings per share, or EPS. We'll get to EPS in just a moment. For example, if a stock is trading at $100 per share and its earnings per share for the year are $5, the P/E ratio is 20. This means you are paying $20 for every $1 of the company's annual earnings. So, what does a high or a low P/E mean? A low P/E ratio, say under 15, might suggest that a stock is undervalued or a bargain. It could be a solid, mature company that the market is overlooking. On the other hand, a high P/E ratio, like over 30 or 40, often indicates that investors expect high future growth. Tech companies like Nvidia, for example, often have very high P/E ratios because the market is betting on them to innovate and grow their earnings exponentially. But a high P/E can also be a warning sign. It could mean the stock is overvalued and due for a correction if that growth doesn't materialize. There's no single good P/E ratio. It's all about context. You have to compare a company's P/E to its own historical average and to other companies in the same industry. Now, let's move on to the metric that powers the P/E ratio, E, or earnings per share. This is one of the most fundamental indicators of a company's profitability. EPS tells you how much profit a company generates for each outstanding share of its stock. It's like slicing up the company's total profit pie and seeing how big of a slice each shareholder gets. The formula is simple. You take the company's net income, subtract any preferred dividends, and then divide that by the total number of common shares outstanding. A higher EPS is generally better because it means the company is more profitable. But what you really want to look for is a consistent history of growing EPS. Let's look at Apple. For years, Apple has shown a remarkable ability to consistently increase its earnings per share. This is a sign of a healthy, growing company that is creating more and more value for its investors. A company with declining or erratic EPS, on the other hand, might be facing challenges. When you're analyzing a company, don't just look at one quarter's EPS. Look at the trend over the last 5 to 10 years. Is it going up? That's a powerful green flag. Next up, we have a critical indicator for assessing financial health, the debt-to-equity ratio. This metric tells you how much debt a company is using to finance its assets compared to the amount of money invested by shareholders. Think of it like a personal mortgage. If you have a $500,000 house with a $400,000 mortgage, your debt-to-equity is quite high. If you have a $50,000 mortgage on that same house, you're in a much more stable position. For companies, it's the same principle. The formula is total liabilities divided by shareholders' equity. You can find both of these numbers on a company's balance sheet. A high debt-equity ratio, say above 2, can be a major red flag. It might mean the company is too reliant on borrowing and could be in trouble if interest rates rise, or if it has a bad business year and QOE, and make its debt payments. Some industries, like utilities or banking, naturally have higher debt levels. But generally, a lower ratio, ideally below 1, indicates a more financially stable, conservative company. It shows that the company is financing its growth more through its own earnings rather than taking on risky debt. A company with low debt has more flexibility to navigate tough economic times and invest in future growth. Now, for a metric that was a huge favorite of Warren Buffett himself, ROE, or return on equity. This is the key to finding companies that are incredibly efficient at generating profits. ROE measures how much profit a company generates for every dollar of shareholders' equity. In other words, it tells you how good the management team is at using investors' money to make more money. Imagine you gave 2 business managers $100 each. At the end of the year, the first manager returns your $100 plus an extra $20 in profit. The second manager returns your $100 plus an extra $5 is. The first manager generated a 20% return on your equity, while the second only generated 5%. Clearly, you'd want to invest with the first manager. That's what ROE shows us. The formula is net income divided by shareholders' equity. Buffett famously loves companies with a consistent ROE of at least 15% to 20%. Let's take Coca-Cola, a classic Buffett investment. It has historically maintained a very strong ROE, showing that it has a durable competitive advantage and is exceptionally good at turning shareholder capital into profits year after year. A company with a high and stable ROE is often a sign of a high-quality business with a strong management team. Of course, a company can't be a great investment if it isn't growing. That's where our next indicator comes in, revenue growth. Revenue, or sales, is the top line on the income statement. It's the money coming in the door before any expenses are taken out. While profits are crucial, you first need sales. Consistent revenue growth shows that there is increasing demand for a company's products or services. You want to look at a company's revenue growth rate on a year-over-year basis. Is it growing at 5%, 10%, or even 20% or more annually? A company that's expanding its sales is capturing more market share, launching successful new products, or expanding into new markets. A company with stagnant or declining revenue, on the other hand, is a warning sign. It might be losing out to competitors or operating in a shrinking industry. Take a look at a company like Microsoft over the past decade. Their successful pivot to cloud computing with Azure has fueled massive revenue growth, which has been a huge driver of their stock performance. When you see strong, consistent revenue growth paired with the other positive indicators we've discussed, you might be looking at a real winner. Finally, for all the income investors out there, let's talk about the dividend yield. A dividend is a portion of a company's profits that it pays out directly to its shareholders, usually on a quarterly basis. The dividend yield tells you how much a company pays you in dividends each year relative to its stock price. It's essentially a reward for owning the stock. The calculation is simple. You take the annual dividend per share and divide it by the stock's current price. For example, if a company pays an annual dividend of $2 per share and its stock price is $100, the dividend yield is 2%. For investors seeking a steady stream of income, especially retirees, a solid dividend yield from a stable company can be very attractive. Companies that pay dividends are often mature, profitable, and have a history of generating reliable cash flow. Think of companies like Johnson & Johnson or Procter & Gamble. However, a very high dividend yield can sometimes be a trap. It might be a sign that the stock price has fallen dramatically because the company is in trouble, and the dividend could be at risk of being cut. So, you want to look for a reasonable yield from a company with a long history of paying and, ideally, growing its dividend over time. So, how do we put this all together? An indicator in isolation doesn't tell you the whole story. You need to use them together to get a full health check of a company. Let's imagine we're comparing 2 fictional companies. Company A has a very high PE ratio, negative earnings per share, a dangerously high D to equity ratio, and falling revenue, even if it pays a high dividend. The other metrics are screaming danger. Now look at Company B. It has a reasonable PE ratio for its industry, consistently growing EPs, a low debt-to-equity ratio, a strong return on equity of 20%, and steady revenue growth. This is the profile of a much healthier, more attractive investment. You should create a checklist with these 6 indicators and run every potential stock through it. It's this combined analysis that gives you the confidence to make a smart decision. Now that you know the secrets the pros use to analyze stocks, I want to hear from you. Which of these 6 indicators do you find most useful or interesting? Are there any others you use in your own analysis? Let me know in the comments below, and I'll be sure to answer your questions and join the discussion. If you found this guide helpful and you want to master your finances and become a more confident investor, make sure you subscribe to our channel for more in-depth content just like this. And don't forget to share this video with a friend or family member who needs to see it. Thanks for watching, and I'll see you in the next video.